The next chapter we're going to cover is chapter 22, entitled Budgeting. And before we get to that, let's just spend a moment in terms of recapping where we've been. So we spent the first three chapters really talking about cost measurement. Okay, so how do costs work and how do costs flow through the various inventory accounts into cost of goods sold in a manufacturing entity. And so chapters 15, 16, and 17 really looked at how those costs are measured and how they end up finding themselves in the various inventory accounts and in cost of goods sold under both a job cost and a process costing environment. From there, we looked at how we would allocate support department overheads. We looked at how we allocate joint costs. And then we looked at some alternatives in terms of allocating factory overhead, including activity-based costing. So it's really all about trying to get the costs properly allocated to the products. Then we spent two chapters really looking at the different behavior of costs, variable costs and fixed costs. We introduced the concept of contribution margin, and that was all really to understand what's the effect on our cost structure of changes in volume, changes in cost that arise. And then we went so far as to look at what's the difference between absorption costing and variable costing, where we have different production levels and how profit can be altered based upon different production levels in absorption costing. So that was really chapters 15 through chapters 21. And the idea behind that was really, ultimately, we wanted to understand what the cost of our manufactured product was. So we wanted to understand what our cost structure was relative to the sales of our product, but ultimately, what was the cost of that product that we just manufactured? And the reason for that was we wanted to be able to make costing and pricing decisions based on that information. So when it's time to set pricing decisions, make pricing decisions on a product, it's imperative that we know what the cost of that product is, so that we make correct pricing decisions in the marketplace. And we also need to know the cost of that product from a competitive point of view and from a production efficiency point of view. So all of those are very important considerations. And again, those were really chapters 15 through 21. So that takes us really to sort of this next group of chapters, and this is going to be chapters 22, 23, and 24. And that really leads us into what I like to just call performance measurement. So now what we're going to do is really consider, once we know the cost of our product, how are we doing relative to what we would like to do? In other words, what are our actual costs versus our targeted costs or our goal? So what we're going to basically do in these next three chapters is take a look at setting specific goals and then measuring our actual results against those, and then being able to determine how are we doing relative to that. From that, that's going to help us to better manage the business. We're going to understand where we're doing well, where we're doing poorly, and it's going to help us determine how we can run the business more efficiently and guide us in our decision-making process. So budgeting basically is the process of setting the goals. So that's the first step. Up above, in the first 6 or 7 chapters, we basically understood how actual costs come together. And now budgeting is going to allow us to really set our target costs or set our goals so that we can measure those actual costs against those. So this is where we're setting the target. So again, just like you would make a budget in your personal life, these are going to be budgets that we're going to measure actual results against. And budgets can be at different levels of the organization. We can have a budget for the entire company. We can have a budget for a specific department. We can have income statement budgets. We can have balance sheet budgets. What we're going to focus on is really the income statement budget, and really ultimately within the income statement budget, really the cost of goods sold budget. So that's really going to be our focus in terms of this particular class. Okay. Budgeting, if you just look at kind of the process, kind of a planning aspect, that leads to directing and then controlling. So planning basically refers to this idea of putting together the targets, putting together the budget. What is it we're going to try to accomplish? Directing is basically then putting in place the necessary strategies or actions, or executing those plans that we put in place to get us to where we need to go. And then controlling is, of course, then measuring. How are we doing relative to the plans? And then again, that really provides feedback into the planning process, because depending on how we're doing, that's going to alter the planning process and the budgeting process as we go forward. So, types of budgets. Usually, budgets are done monthly. And the reason for that is because we want to know how things are going, and we want to have that information on a timely basis so that we can make adjustments to our business before things get out of hand, or so that we can do them on a timely basis. So if we were to wait and do budgets once a year, by the time we got that information, it would be too late to put into place actions to improve the business. So if we do budgets monthly, at that point in time, we're able to react and we're able to take actions to correct any problems we're seeing within the business. Usually there's two types. One is fiscal year budgeting versus continuous, and these are in the textbook. You can take a look at that. Continuous. Fiscal year means we're just going to look at the current year, and each month that goes by, we just have many fewer months. So if we are in June, we only have 6 more months to go. Continuous means that we always have a rolling 12-month period. So if we're in June, then we would go to the following May, and so we'd have a continuous 12 months. So we'd always have a 12-month period. The fiscal year is we're just looking at that particular year, and if we're in November, that means we'd only have 1 more month to go after that. The other ones are static versus flexible budgets. Static budgets really just allow for one activity level. Flexible budgets allow for multiple activity levels. So for instance, a static budget, there would be one number that would be set as a budget figure. For instance, the accounting department might have a static budget of $1 million. They're going to spend $1 million whether or not the business does 10 million in sales or 12 million in sales. That $1 million is not going to change. Flexible budget, on the other hand, would be, for instance, on cost of goods sold, where we'd have variable costs, where if we do more volume, then our budget is going to increase based on that additional volume. So it's going to give effect to the fact that we're going to have higher activity, increased volume, so our budget amount or our target is going to go up. So for instance, if we did 10 million units, our cost of goods sold budget would be higher than if we did 8 million units. And so again, that's something that you'll be able to see in the textbook. So basically what we're going to do is we're going to look at the master budgeting process. And everything is going to start with the sales budget. So these are the operating budgets. So of course we'd have a sales budget. And of course all of this is to get to a budgeted income statement. And we would compare that to our actual income statement to see how we did relative to sales, cost of goods sold, expenses, etc. So we'd have a sales budget. We would have a cost of goods sold budget. And within cost of goods sold, we would also have a production budget, and we'll work through each one of these. Based on production, that would tell us how much direct materials we would have. So we'd have a direct material purchasing budget. So how much direct materials do we need to purchase? How much direct labor? And how much factory overhead? So all of these would be separate budgets and part of the cost of goods sold budget. And then we'd also have selling and administrative budget. So what we're going to focus on, we're not going to worry about the sales budget, and we're not going to worry about the selling and administrative budgets. We're really going to just focus on the cost of goods sold budget and the 4 operating budgets that are part of that: production, direct materials, purchases, direct labor, and factory overhead. Once we put that together, that would be combined with our sales budget, combine that with our selling and administrative budgets, and all that comes together, and then that would give us our income statement budget, and we would of course compare that then to our actual income statement results each month, and that would tell us how we're doing, and from a sort of a top line point of view, or from a total point of view, how we're doing relative to our targets. And then the next chapter is really going to be looking at direct materials, direct labor, and factory overhead, measuring each of those relative to the targets that we've set up. So we'll deal with that in the following chapter.